right? Then you try to calculate the probability of default. And obviously, if it's a prime borrower, the probability of default is going to be lower. Then you package, you repackage, you slice, you reslice, and you sell it out. So sounds like a scam, right? Sounds like a scam a little bit, but it's not. So by doing this, they could lower the interest payments. They could lower the interest payments for everyone in the world. But however, then, once they lower the interest payments, then the next pool of people, which would be subprime borrowers with lower income, could step in, and that's how it's kind of like started to unfold. But originally, when those houses were set up, and why were they set up? Well, actually, they were set up to encourage home ownership in the United States. So once they were set up, they were still attracting mostly good quality borrowers, right? So there was not a big problem there. There weren't many defaults going on. And plus, since these institutions were government-chartered investors, government-chartered investors around the world perceived them as having an implicit government guarantee. And it was a little bit of a mistake, because although they were government-sponsored enterprises, at the same time, they operated as private businesses. And I also need to understand that not only those two major companies, Freddie Mac and Fannie Mae, were participating in this type of kind of like collecting mortgages and repackaging them, slicing and selling to investors. Actually, there were other smaller companies. So there were lots of private companies. So it was a very competitive business. So what I'm trying to say here, if these companies, government-sponsored companies, were not doing it, there would be other companies doing it. There was a great demand for this type of securities. So the investors perceived them as having an implicit government guarantee, which were right, because these were the companies that got bailed out, right? But some other companies were not bailed out. So when investors were buying those securities, sometimes it was very hard to figure out whether, it comes from a state-sponsored company or a private company. So this is just a picture how it works. So in the 80s and 90s, it was all funded before the 50s, it was all funded, the mortgages were funded by the deposits from savers. Then the government-sponsored enterprises start collecting mortgages from people, and they collect mortgages from banks, mortgage originators. So, and then they were the mortgage originators were fund more and more mortgages to the investors. But then in 2000s, so the residential mortgage-based securities that are not issued by those government-sponsored enterprises had to pay investors a high premium to compensate for the higher default risk. So there were other companies that were engaged in the same type of business, right? Those companies were not sponsored by the United States government, so the investors were demanding higher premium for the possible default risk. However, without financial innovations, the cost for the mortgage takers would have been too high for the target borrowers. So there was lots of kind of financial innovations going on, how they could slice those mortgages and lower the interest rates and offer the better price for investors. And lots of complicated quantitative models were developed to predict the likelihood of default for the various levels. And that all worked well. That all worked well as long as the price of the underlying asset and the underlying classes would be there, the value of the homes, the price of the homes. Everything was working well as long as the price kept rising, right? So initially, you had low interest rates, the property values started going up, everyone was happy because the price of the underlying asset was going up. However, then there was a downturn in housing prices, and this is when it all started unfolding. So initially, you have the increase in price of the underlying assets, the mortgage originators and investors, they were very happy about this, and more and more people could afford those mortgages, right? As more people can afford the mortgages, the demand for housing increases, the value of the houses increases. So it seemed like a perpetual upward trend, perpetual bubble. So these complicated finance models allowed the markets for securities backed by non-prime loans. Then, in addition to government-sponsored enterprises, there were kind of like lower-scale investment houses that were engaged in this kind of speculation, and they were repackaging those mortgages and reselling them to investors all over the world. So the mortgages from the United States could be easily sold to institutional investors in Iceland or Norway. They could be sold to pension funds. They could be sold to mutual funds. They could also be sold to the governments. So one thing to keep in mind, it's not only that the greedy Wall Street decided to come up with those complicated securities, try to kind of confuse everyone, right, just at the expense of the investors trying to make money and collect good salaries and bonuses. There was a great demand for these types of securities. There was a great demand for these types of securities because of the kind of like recent growth of the world economy and the wealth creation. Think about the kind of like new economic players, the such-called BRIC countries, Brazil, Russia, India, and China. So the wealth of those nations increased dramatically recently, right? So they had a lot of money floating around, a lot of cash floating around that has to be invested, right? So when, let's say, for example, Chinese foreign currency reserves are now around 1.5 trillion, right? And this is pretty much 10% of the gross domestic product, the national product of the United States. That's a lot of money. So you have 1.5 trillion sitting down there in the vaults of the central banks, right? I mean, you don't want this amount of money just to be there, right? I mean, it's hard to store so much cash, right? So it needs to be invested. However, if you work as the central bank, if you work for the central bank in China or Russia, you don't want to gamble that money, right? You don't want to gamble this money, so your options are pretty much constrained to investing to something safe. There are not so many safe options around the world. So the safest security considered would be the government debt of the United States, the treasuries, the treasury bills, right? So this is security which offers you low interest rate, right, but it's considered to be safe. However, there was just not enough American securities, government securities, to satisfy this increased demand for liquidity, increased demand for wealth in other countries. So they had to invest it somewhere. So the central banks in Russia and China, they were looking for some safe assets. So they chose this asset. They chose the assets which were backed by the mortgages from the United States. And it all looked safe. It all looked safe because it was kind of like guaranteed by those government-sponsored enterprises. And they were, in addition to that, they were offering high rate of return. So there was a great demand for these assets to begin with. It's not only that the Wall Street were aggressively selling those securities, but people, investors around the world were very willing to pay a good price for those securities. So this is how kind of like a picture changed with the creation of these markets in later stages. Then this non-prime boom started to kind of like to unfold. So investors realized that they had purchased non-prime mortgage-based securities with overall optimistic expectations about the default risks. Also, credit rating agencies such as Moody's or Standard & Poor's contributed to this overall optimistic expectations by giving those securities A-level ratings, right? So when the Wall Street was selling those securities to governments, institutional investors, and pension funds around the world, right, they were pretty much sold as a safe security. Well, if you say that my security is safe, you want to sell like an asset, and you say that it's safe, you have to back up it with some guarantees, right? So the regular credit rating agencies such as Moody's and Standard & Poor's were giving them high-level ratings, right? A or AAA. So the AAA is as safe as government-issued bonds. So right now there is some speculation that actually, you know, there could have been some kind of conspiracy and collusion going on between the people who were trying to pitch those securities, sell those securities, and the credit rating agencies which are giving high safe grading for those securities, right? Whether there was collusion or not, I mean, it's hard to say. But as you probably read in the news, the Federal Bureau of Investigation, FBI, is after some of those